Hi, I'm Jimmy. In this video, we're going to look at how to value stocks in the communication services sector. Now, this sector has a ton of different types of companies. We got these. We also got companies like AT&T or Verizon or Disney, Warner Brothers Discovery, Netflix. There's a wide group of stocks here. So we're going to go through different valuation methods that are most appropriate for these types of companies. Now, to come up with these, not only did we use my personal experience, but I also reached out and looked at analyst reports and reached out to different analysts that analyze these types of companies and have looked at what valuation methods have proven to be most reliable for these particular stocks. Then, towards the end of this video, we're going to look at some companies that look like they could be undervalued today using these exact valuation methods. Now, before we get into that, I just want to tell you real quick about a website that we're building where we're trying to make it easy to analyze companies and value companies quick and easily. You're going to see some of the charts and some of the analysis that we do on the website here. We also have a private investing community that if you get access to the website, you get access to the private investing community where we do 3 live streams per week, where we look at macroeconomics, we look at building portfolios, analyzing companies, valuing companies, things like that. Whole bunch going on over there. It's pretty exciting. If you're curious, I will leave the link in the description below for how to get access to that website. Okay, now let's jump in and look at our first valuation. So as you might guess, the first valuation method is discounted cash flow. It is said that a company is worth today is the present value of all future cash flows. That's a fairly popular saying. Buffett's been saying it for years. That's essentially what we're trying to come up with. Well, on the website, we have a chart that looks something like this. And basically, anything to the left of this arrow is a good thing. If it's to the left, it looks like it could be undervalued. In this example company here, the fair value is about 150, stock's trading at about 115. So it looks like it's a bit undervalued. Now, based on the research that we do, we also want to pay attention to the margin of safety. The margin of safety is the difference between the current price and the fair value. So the bigger that margin of safety, in theory, the bigger the cushion you have. Because the way discounted cash flow is calculated is we use analyst estimates or computer estimates, depending on whether or not we have analyst estimates. We take analyst estimates and we discount those estimates for free cash flow back to today. It's almost as simple as that. And ideally, you do your research and then you want the margin of safety to exceed what your determined margin of safety is. So I'll do my research and say, okay, based on my analysis, I want a 20% margin of safety. Well, if that's the case, 24% margin of safety looks pretty good. Okay, so that's one valuation. The next valuation method, again, especially for companies that are larger and are profitable, this is a popular one. And because of how popular it is, you almost can't ignore it. If a company is profitable, reliably profitable, price to earnings multiples are very, very useful. But the key here is that we look at the history of the stock. This is another example, another sample company, but this chart goes all the way back for the past 10 years, and we can see what the price to earnings multiple is. We have 3 different averages on the chart there, the 5-year, 10-year, and 20-year averages. Ideally, if you could buy below those, you're doing pretty good. Well, the same is true for the next valuation method, which is enterprise value to EBITDA. Again, the idea here is that you want to buy it below the average. So instead of taking the average of, let's say, something like the S&P 500, which might not be very industry or sector specific, well, instead of taking that average, you could take the average of the company, which is the simplest way to do it. Or you could take the average, maybe this company doesn't have a huge history, take the average of peers of the company, the industry or the sector in general. Now, the idea is, again, we want to buy it below the enterprise value to EBITDA number. Now, let's pretend that the company is smaller and the company doesn't have positive earnings. It's not profitable, so net income is negative. Well, PE doesn't work. Enterprise value to EBITDA could be a good valuation method. But if the company is real young, real small, and kind of the startup phase, well, then using something like enterprise value to revenue is by far the best way to use it. Now, again, with this, I would look at its own history, if there is a history of the company, but then if there's not, look at the history of some competitors. Surely there are competitors out there. Find the history of those competitors and then determine what is a reliable enterprise value to revenue number to use. Then ideally we want to buy below that average. Don't necessarily look at what the S&P 500 is doing or global indexes or US stock market indexes. Look at it specifically for that industry or for that company. Okay, now let's jump over and look at some stocks that could be undervalued right now in the communication services sector. So first up, we've got Comcast, ticker symbol CMCSA. And we could see that the fair value is coming in at about 43 bucks per share, and the stock price is trading slightly below 40. So we got about a 10% margin of safety. So this one could be an interesting one to consider. Now, like I mentioned before, when we scroll down here, well, we can see both historical numbers for free cash flow, and we can also see what analyst estimates are. Now, I used baseline conservative numbers, the default for the website here, which is that we're using a perpetual growth rate of 2.5%. So the assumption here is we take 3 years of analyst estimates, and then in the fourth year and going out into the future, it grows at 2.5%. And in most cases, that's probably a bit conservative, but I don't mind being conservative when we're trying to come up with a fair value for a stock. Next up, we've got the Interpublic Group, ticker symbol IPG. Well, here we can see the fair value is at about 41 bucks per share, and the stock's trading slightly below 30 as of the shooting of this video. That's almost a 30% margin of safety. Now, I think it's important to many times to double check on different valuation methods. And when we jump over to price to earnings, first thing I would point out is this chart is the price to earnings multiple. Now, if you look at the table here, it looks like it's undervalued. Green is good, red is overvalued. Green is undervalued, red is overvalued. Simple enough. But it's kind of tough to see the chart. So if on the website you were to click on the individual data points that are really throwing it off, you could do this for a couple of them. And when you do, well, the chart ends up looking a bit more like this. Zoomed in, we can see it's easier. Now, this stock is fairly wide ranging, but clearly there's an obvious bottom here, an obvious good spot to buy it, which is, let's say, below 10x. Below 10x might still be a little bit too high. But again, this is one of the reasons why we want to avoid using something like the S&P 500 average, and we want to look at their own historical numbers. Here, if you bought it below 10x, you're doing pretty good from a long-term valuation perspective. Don't forget, this chart goes back the past 10 years. This is a quarterly chart going back the past 10 years. So here, IPG looks like it could be undervalued using both discounted cash flow and price to earnings. Now, what about if we wanted to use a different valuation? What about something like enterprise value to EBITDA? Well, here, enterprise value to EBITDA, when we're looking at a company like Amazon, well, enterprise value to EBITDA, the current number is slightly below 2 out of the 3 averages. In fact, when we zoom in on the table, well, we can see that the 10 and 20-year averages look like it's undervalued, while the 5-year average looks like it's a bit overvalued. Now, if nothing else, this is, I think, a good starting place for many companies. Now, I actually did an analysis of Amazon in our Magnificent 7 series that we're currently working on. Well, that one, I will leave a link to that video in the description below if you're curious. In that video, we actually changed the settings for free cash flow, and this is the way the free cash flow numbers ended up shaking out. And you can see some of our settings right here. So Amazon, based on analysis, or based on my analysis, actually looks like it's reasonably undervalued. We get about a 10% margin of safety here. And if you're curious, those are settings over there. So I think Amazon's pretty good. It's currently sitting in my bullpen. I haven't jumped in and bought it yet, but I do think it's an interesting company. I'll leave a link to that video in the description below. And if you'd like to go ahead and get access to this website, again, I will leave a link to that in the description below. And if you're curious how to analyze companies, I actually did a YouTube video called 8 Steps to Analyze a Stock. I will leave a link right there and a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.